Are you losing sleep watching the stock market twist and turn like a roller coaster? If you are within 5 years of retirement, or if you have already crossed that finish line, I know exactly what is keeping you awake at night. You are looking at your 401k, your IRA, your hard-earned nest egg, and you are terrified. You are asking yourself, what if the market crashes right when I need to start pulling my money out? What if everything I have worked 40 years to save vanishes into thin air, and I am left with nothing? Listen to me. It is completely normal to feel afraid. Fear is a human emotion, but fear is also the absolute greatest enemy of your financial security. When you let fear drive the bus, you make mistakes. And when you are close to retirement, you do not have the time to recover from stupid, emotional mistakes. Today, we are going to put an end to the panic. We are going to address the real problem, face those fears head-on, answer the tough questions, and give you a concrete, unbreakable plan of action so you can stand strong, no matter what Wall Street does tomorrow. Let's talk about the real problem here. The problem isn't actually the stock market going up and down. The stock market has always gone up and down, and it always will. Here is your actionable takeaway. This is what you must do right now to protect your future. I want you to look at your money using a strategy called the bucket method. Your first bucket is your security bucket. This is your shield against market volatility. For anyone within 5 years of retirement or already retired, you need to have 3 to 5 years of your net living expenses sitting in completely safe, liquid, guaranteed cash or cash equivalents. I am talking about high-yield savings accounts, certificates of deposit, or short-term treasury bills. Look at your retirement budget. Calculate exactly what it costs to keep your lights on, put food on your table, and pay your healthcare premiums, minus whatever guaranteed income you have coming in from Social Security or a pension. Whatever that gap is, multiply it by 3, 4, or 5. That money goes into bucket number 1. Why do we do this? Think about it. The average bear market lasts about 1 to 2 years before it recovers. If the stock market takes a massive nosedive tomorrow, you do not have to touch a single stock or mutual fund. You don't have to sell anything at a loss. Why? Because you have 3 to 5 years of cash sitting safely in bucket 1 to pay your bills. You can look at the television, see the red numbers flashing on the screen, take a deep breath, and say, I don't care. My lifestyle is funded for the next few years. I can afford to wait for the market to heal. That is how you buy yourself peace of mind. Your second bucket is your income and safety bucket. This is for money you will need in years 6 through 10 of your retirement. This bucket shouldn't be in wild growth stocks, but it shouldn't be in basic cash either. This is where you utilize high-quality fixed income investments. We are talking about investment-grade bonds, a bond ladder where your bonds mature year after year right when you need them, or conservative dividend-paying stocks from solid, stable companies that have a history of paying out income even during recessions. This bucket gives you a higher yield than cash to keep up with inflation, but it keeps your principal relatively safe. Then, and only then, do we talk about your third bucket, the long-term growth bucket. This is the money you will not need to touch for 10, 15, or 20 years. Because remember, retirement isn't a single day, it is a journey that can last 30 years or more. You still need your money to grow so you don't outlive your savings. This bucket stays invested in the stock market, in diversified index funds or exchange-traded funds. When the market drops, you leave this bucket completely alone. You don't look at it, you don't touch it, and you let it ride out the storm because you know you have buckets 1 and 2 protecting your daily life. Another critical step right now is to look at your withdrawal rate. For years, Wall Street told you that you could safely withdraw 4% of your portfolio every single year in retirement. I am telling you right now, the old rules are dead. In a volatile world with higher costs of living, a 4% withdrawal rate is pushing it too close to the edge. If you want to sleep soundly at night, aim for a conservative 3% withdrawal rate from your investment accounts. If you pull less money out during the down years, you give your portfolio a massive advantage to survive and thrive for the long haul. Look at your income streams strategically. If the market is down and you are tempted to claim your Social Security benefits early at age 62 just to get some cash flow, pause and think. Claiming at 62 permanently slashes your monthly benefit by up to 30% compared to waiting for your full retirement age. If you can use your cash reserves from your security bucket to bridge the gap and delay claiming Social Security, your guaranteed lifetime benefit grows by about 8% for every single year you wait past your full retirement age up to age 70. That is a guaranteed return you cannot find anywhere else on earth. Protect that guaranteed income stream. If you are looking at the market today and feeling that knot in your stomach, do not ignore it. That knot is a warning sign that your current asset allocation is too risky for your peace of mind. But do not react with panic. React with a plan. Clean up your portfolio. If you have individual speculative stocks, sell them and move toward diversification. Build that 3 to 5 year cash buffer immediately. Tighten your belt on non-essential lifestyle expenses right now if you need to build up that cash. You have worked too hard, saved too long, and sacrificed too much to let a temporary downturn in the stock market steal your joy and your future. True financial freedom isn't just about the number in your bank account, it is about having the power to control your emotions and having a plan that protects your peace of mind. Build your buckets, secure your cash, lower your withdrawal expectations, and stand secure. You can handle this volatility, but you must choose to be strong, you must choose to be smart, and you must protect your future self today.